In CPCU 540, there are several key concepts that are alluded to right from the start and continue to come up repeatedly throughout the course. But for some reason, the Institutes doesn't go over those concepts until later, or they simply gloss over them. Thoroughly understanding these concepts will make a huge difference in your ability to grasp the content from CPCU 540. So we created this 3-part fundamental series to provide you the knowledge upfront and give you that edge. Our number one tip for CPCU 540 students is to start by learning the accounting equation, which is the backbone of how all accounting information is organized. Very simply, the equation is as follows. Assets equals liabilities plus equity. Assets refers to any property of value. It can be tangible things like cash, real estate, fleet vehicles, and so forth. Or it can be intangible stuff, like the value of a copyright or a patent. In any business, you'll use your assets to produce a good or provide a service that you can sell, which hopefully generates profits for you. Liabilities refers to any legal obligations you have to repay money back to someone within a specified time. It's important to note that moral obligations don't necessarily count as a liability, only legal financial ones, where someone has the right to sue you if you fail to pay them back. For now, just think of equity as a catch-all category that includes anything that doesn't count as a liability. There are a lot of other terms that are used interchangeably with the word equity, such as net worth or book value, but in our course, we'll stick to the term equity. We'll clarify what equity is a little later in this video, after we explain some other things first. Essentially, the accounting equation is saying that anytime you obtain something of value, meaning an asset, you're going to keep track of whether you got that asset by 1, taking on a liability, or 2, taking on equity. Think of the two sides of the equation as being on a balance or scale. On one side, you have a large assets bucket, and on the other side, you have a liabilities bucket and an equity bucket that together weigh the same as the assets bucket. Anytime you drop something into the assets bucket, you must put an equal amount to offset that in either the liabilities bucket or the equity bucket or both. The easiest way to understand this is to use an example. So let's walk you through how the accounting equation might develop and play out if you were to start a food truck business. To start a new company, you need money to buy things. One option is to borrow the money, like by taking out a loan from the bank. If you decide to borrow $50,000 from the bank, you would receive that much in cash and record it on your assets side. The loan would count as a liability, so you would mark an offsetting entry in the liabilities section. At this point, your accounting equation is assets of $50,000 cash equals liabilities $50,000 for the loan. Now, you also have the option of not borrowing money, and instead, you could just tap into your own personal savings, assuming you had enough, to use as your starting seed money. If you went with this option, you would still show the same $50,000 of cash on the assets side. However, the other side would show an entry in your equity bucket instead of in the liabilities bucket, since you don't have any obligation legally to pay back the $50,000 from your personal savings to anyone. In that situation, your equation would be assets of $50,000 cash equals equity of $50,000 in initial capital. In comparing the two situations, having more equity always looks better than having more liabilities because you don't have a legal obligation to pay the equity part back to anyone else. Liabilities are basically someone else's money, and you'll ultimately need to come up with the funds to pay that back or to otherwise satisfy the liability. Once you have your starting capital, during the course of your business, you'll need to buy things to run it. Let's say you spend $30,000 of your money to buy a food truck and another $500 to get food supplies. All you're really doing here is splitting your assets into multiple categories of cash, supplies, and vehicles. You haven't actually increased what you have altogether, so your total on both sides of the equation would still be $50,000. Now let's say you use those $500 of food supplies to create some dishes to sell, and you bring in $1,500 in cash, putting you at a new total of 21 grand for your cash. But remember, the accounting equation must always balance, and right now you technically have $1,000 more in assets than you did before. That means you also need to increase the liabilities/equity side of the equation by the $1,000 of profit you made. Anytime you increase or decrease your total assets, you will always have a corresponding increase or decrease to the other side of the accounting equation. There are no exceptions to that rule. So the question is, how do you know whether to put the change under the liabilities part or the equities part? The main question you would want to ask yourself is, did you get the asset by incurring a new debt or a new financial obligation that you're required to pay back or satisfy? If so, the offset belongs in the liabilities bucket. If not, then you're good to stick it under the equity section. In this case, the extra $1,000 is self-made profit that you created without incurring any new debt to anyone, so it can go under the equity side. At this point, your accounting equation would balance and now has $51,000 on both sides. Now, what if you spotted a great deal on a second food truck for 20 grand and you wanted to buy it to expand your business? If you decided to use part of the $21,000 of cash you still have, that would only leave you with $1,000 afterwards, which probably isn't enough money to buy more food supplies and hire a driver for that second truck. If you decide to borrow the $20,000 by taking out a loan, then you would add $20,000 to your vehicle's total on the assets side to reflect the new truck, but you would also have to add $20,000 under the liability side to show the corresponding vehicle loan. This would balance out both sides and bring the total on each side to the same amount of $71,000. We can also use a personal finance example to help you better grasp the liabilities versus equity concept. People often talk about buying a home to build equity. What they're referring to is another illustration of the accounting equation. When most people buy a home, they can't afford to pay for it outright in cash, so they borrow a good chunk of the money they need. Let's say you buy a home that's priced at $250,000, and you're able to put 20% down, which is $50,000. That means you would have to borrow the remaining $200,000 in order to pay the seller. After the transaction goes through, you could say that the accounting equation for the home looks like this. Assets of $250,000 for the home equals liabilities of $200,000 for the mortgage plus equity of $50,000 for the down payment you made. Now, as soon as you start to pay off that mortgage loan, your liability to the bank will start to go down because you owe less and less to your bank as time goes by. But the purchase price of the home doesn't change, so there wouldn't be any adjustments to the asset side of the equation as you make your payments. Instead, you would offset your liabilities reduction by increasing the equity portion. If, for example, your first mortgage payment was for $1,000 and it all went to the principal, you would subtract $1,000 from the liability section, and then you would increase the equity side by the same amount. As you continue to pay off more and more of your mortgage, your liability will keep going down and down and down, and your equity will keep going up. You can see then that the equity portion is basically the portion that you own free and clear. It's the part that's truly yours, and it represents the portion of your home that isn't owed to anyone else. To put it another way, until you fully pay off your mortgage, it's not like you really have a $250,000 home. You have part of a $250,000 home. If in the middle of paying off your loan, you had to sell the house for some reason, it's not like you get to keep the entire $250,000. You'd still have to pay off the bank for whatever balance you still have on your mortgage before you would get to keep any remainder amount, which would be the equity portion. In the same way, when you're looking at a business, that's why keeping track of their liabilities versus equities is so important, because it tells you how much of their assets are truly theirs. If a company has a lot of assets, but also a lot of liabilities, It basically means they're running themselves on borrowed money. Kind of like if a person has a fancy car and nice clothes and expensive gadgets, but they're paying for it all with credit cards, that's not a good thing. Yeah, they have a lot of stuff, but they also have to pay a lot of money back. You can see that equity essentially refers to non-debt sources of money. The next thing that's helpful to know is the two main sources of equity for businesses. Most businesses build up their equity portion in one of two ways. The first way to beef up your equity is with contributed capital. This refers to money that people contribute or invest into a business that isn't structured as a loan. We'll talk more about how that works in the next fundamentals lesson when we talk about stocks. The second way to beef up your equity is with retained earnings. This refers to the profit that a company makes on their own sales and that they choose to keep within the company rather than distributing or sharing those profits with the company's owners. Companies can choose to either give away the profits they made to the company's owners, or they can hang on to that money and use it to build up their cash reserves. Companies will often do the latter because they always need money to continue paying expenses and if they want to keep expanding. In general, when given a choice between buying stuff with equity or buying stuff by incurring a liability, it's preferable to go with equity. You want most of your stuff to be yours outright, because if you use borrowed money, eventually you have to pay that back. If you don't have enough money available when it's time to repay those debts, you might be forced to sell off your assets, like your real estate or those food trucks, to generate the cash you need to pay back those loans. The other downside to liabilities is that you usually pay more than the purchase price of the asset because you probably had to pay interest on those loans. Despite those cons, liabilities and debts are still important financial tools because sometimes you just don't have the cash to pay for what you want outright, and borrowing funds is the only way you can finance your purchase. The main thing is that you don't want to overextend yourself and take on more debt than you can actually handle paying back. So now you've got the accounting equation down pat, but how does that help you with CPCU 540? Well, knowing this concept upfront will actually benefit you in several ways. For starters, the accounting equation is one of the many formulas that you'll need to know for the test. So hopefully by now, the equation of assets equals liabilities plus equities is seared into your brain. More importantly though, a lot of CPCU 540 is about learning how different transactions affect the two sides of the accounting equation. Any time that the course talks about how a certain transaction will increase or decrease one or both sides of this equation, you'll totally get it because you'll have a thorough understanding of the liabilities, equities, and asset relationship. On top of that, a lot of CPCU 540 is about how insurance transactions are entered into the three buckets differently than how similar transactions in other industries would be handled, simply because insurance is such a unique product and it's regulated so heavily. To give a quick example, when most businesses, like a clothing store for example, record their sales for the month, they add to their cash on the asset side, and then they offset that by adding to their retained earnings in the equity bucket, because that money was earned on their own without having to incur a liability. An insurance company, though, doesn't record their sales quite the same way. When they collect the premium money at the start of the policy, they do add it to their cash on the asset side since they now have more cash than they had before. However, they don't get to record the income or profit in the equity bucket yet because technically they haven't earned the insured's money. If a policyholder decides to cancel their policy, the insurance company would immediately owe that customer a refund for whatever portion of premium corresponds with the policy term that hasn't passed by yet. That's why that premium isn't considered to be truly earned by the insurance company until the policy term has started to elapse. Because of this, the insurance company has to record the money they got as a liability, because at that exact moment, the insurance company has a legal obligation to give that money right back to the policyholder if the policyholder changes their mind. After part of the policy period has gone by, the insurance company is considered to have earned that portion of the premium, so that part can get transferred to the equity bucket, since the insurance company no longer owes a refund for that part if the policyholder were to cancel their policy. Once the entire policy period has elapsed, the entire premium would fall under the equity bucket because it's fully earned by the insurance company at that point in time. The final benefit of understanding the accounting equation is that you now know why equities are generally more preferable to liabilities. So anytime the course talks about how a transaction will boost your equity, or they warn about a transaction that would deplete your equity, it totally makes sense why they care. Since equity represents the portion of your business that's yours outright, it now makes sense why businesses try to handle themselves in a way that relies more on equity than totally relying on liabilities.